wanted to take a look at the stock market today. And for right now, the stock market is slightly higher. I saw about 0.4 higher for today. It was much higher earlier, over 1%. SPY ETF. We could easily go break even for the day. Now, for those of you who've been following me for any length of time, I had a very large position on TLT ETF as of last Sunday night. I did get out of that position. There was a Wednesday evening, of course, we had the announcement previous week, 10 days ago at this point, the tariffs, Liberation Day, if that's what we want to call it. Thursday and Friday, there was a huge sell-off in the stock market, of course, and then everybody rushed into the bond market. Sunday evening, of course, I sat there, and I did a video on this last Monday morning. I looked at that and said, this was a rush into safe haven relative investments. The bond market will turn right back around. So I took my profits Sunday night. And I looked at a bunch of other things all through the weekend. Not having the market open gave me the clarity to go ahead and pull the trigger on that one event. Then, of course, Monday morning, pretty much close to about the time I published my video last week, the bond market seized up. Bids ceased. Now, here are a few things that you need to understand about that one particular event. No foreign nation stepped in to punish Trump and his tariffs. This was just the bond market. So all the cannon powder is still available for all those countries. I don't think they're going to be doing that. The Treasury market is the bedrock of all financial instruments throughout the world. The U.S. Treasury market. It is so important. The fact that no one stepped in to bid was a vote of unconfidence, if you will. Given that, last Friday we got an economic data point that came out that most people ignored simply because of all eyes were fixated, will the bond market correct itself? It did relatively at this point. 10-year treasuries down to, I think I saw 4.3, somewhere in there. So the 10-year treasury yield has softened up somewhat. But that's not to say what will come next. Several factors are coming in. First, the consumer. Last week, Friday, the data point that everybody ignored, University of Michigan consumer sentiment. This is huge. Tied for worst reading of all time, data going all the way back to 1980. A lot has happened since 1980. That's 45 years worth of economic history. And this is the second worst that the confidence that the consumer is feeling. That translates into Wednesday, we get retail sales, which my expectation from that is if the consumer has seized up like they have, they're not spending money. Retail sales will start to see those numbers this Wednesday with that data point. That will get ugly. So I want to break down stock market today. Economic indicators based on the consumer. The US dollar is selling off. So all the money that has flown into the United States over the past, say, 6-9 months is now leaving because investors have no confidence in the United States, neither do the consumers. So where does that put the stock market today? I think it's on a springboard, and we're going to see a big belly flop. I see a progressively slower move downward. The economy will start to contract significantly. Then we got to deal with in June, the United States federal government has to refinance $8 trillion at interest rates that are likely going to be much higher. I am not buying TLT ETF. I have gotten into inverse ETFs, bond ETFs. I did a video last week on that. You might want to check that out. But I'm going to lay out the case for the stock market continually moving lower because the economy is going to contract from the consumers while money leaves the door and interest rates move higher. Let's jump in. For those of you who've been following me for any length of time, of course, I've moved off of my website and onto Substack. And over the past couple days, my account has just absolutely lit up. Thanks so much for the support. This is, I think, a 90-day period of time. I've been gradually moving in with more and more content over the past week. Of course, a lot of my content is far more relevant. If you're interested, if you're on my YouTube channel watching this, links are down below to my Substack account where this is where I'm prioritizing. Obviously, that's playing out. YouTube, not really that great. Kind of over it. Substack, thanks so much for all those who have jumped over and moved up. This is about a 70% increase in a couple days for me. So, I'm a smaller content creator, but I'll get there. This is my time to really show those individuals, hey, this is what's happening in the economy. This is what will happen in the stock market because of the economy. So if this is the kind of content you're looking for, jump aboard with everybody else. In the meantime, University of Michigan's consumer sentiment versus personal expenditures. Real simple mathematic equation here. You can see the tight correlation between sentiment and expenditures. If a consumer doesn't feel warm and fuzzy, they're not going to be spending money. Expenditures themselves have already slightly started to move downward. They've peaked, we'll say, and likely to move sideways to downward over the course of the next couple of months, quarters. We'll see that data as it plays in. But there's many factors, and this is one of the things about my content. I look at everything. I'm a former FX hedge fund manager, and I follow the currency markets. I follow the money as it flows. Money is leaving the United States. That's such an important factor. And I've been putting out content regarding where money is flowing and why that would be a better investment relative to the United States. I'm waiting for the dust to settle before I start to move in on a lot of these projects. But right now, the dust is being kicked up, and this is an opportunity to kind of get ahead of that. Retail sales, as I said, hits Wednesday, and we'll see how the personal expenditures already is starting to decline before the lack of confidence. Now we're seeing a complete seize up in the lack of confidence. Consumers are simply not going to spend money. Retail sales will start to show that picture. The stock market will react to that event. So I expect Wednesday to be kind of like, whoa. But I don't expect that to be the final sort of nail in the coffin. There will be far more data points reiterating this and showing more and more that the consumer has seized up, and so have revenues to companies. And from that, profits and stocks will begin to move lower. The correlation is pretty strong. You can see that. And I wouldn't be surprised over the next couple of 3 months going in through the summer that personal expenditures declines rapidly. Moving right along, retail sales versus personal expenditures, you can see the tight correlation there as well. I put that in red to kind of highlight what's going on there. Personal expenditures is red. Retail sales, they kind of mirror each other. It's sort of a hand in hand, but confidence is really where it's driven right now. Personal expenditures typically is driven by two things: personal income growth. If your income continually increases at a higher and higher rate, so do expenditures. We're seeing personal incomes decline. That's why expenditures are declining. Now we're seeing confidence plummet, and we will see expenditures kind of moving downward in kind. In the meantime, here's SPY ETF. This gives you an idea as to where things have gone. That peak was just February 18 and 19 for, I think, SPY ETF and QQQ. I think respectively, 18th and 19th, we saw the highs in those equity indexes. Since then, it's been a 22% drop, peak to bottom. I do not expect this to stop falling. That although today we're seeing a calming because someone realizes that there are consequences to actions, this is, we're going to see a lot more downside, plain and simple. The consumer ultimately drives this economy. The consumer is being taxed with tariffs. And here's the thing, make certain you're crystal clear on this. This has nothing to do with trade balances at all. This has everything to do with the fact that the Republican Party is trying to push through legislation that will decimate the deficit. So they're trying to raise revenue. Plain and simple. And all the talking points are nothing more than that. Hey, listen, we're going to solve everything in the American economy because of this, and this. Yeah, whatever. Being able to see through that gives you the opportunity to see what will happen, the consequences to those actions, and how this stock market will continue to move lower because of that. The consumer is being, they hoped to raise $600 billion from consumer expenditures via these tariffs, which likely is unconstitutional to begin with. All tax revenue starts in the House of Republicans, the House of Representatives, my bad. Not one individual with a pen. And the law he's kind of picking, likely all this is being wiped out, all this capital being wiped out, and he can't even do it. That's very likely. In the meantime, I can see 2022 highs and lows being challenged. It's going to get that bad. I can see the consumer bypassing corporate America and going straight to the distributors or manufacturers in China. That will be a movement. It may take a while, but consumption habits will shift. So this bubble is done. We'll easily see the mid-range of 2022 and 2023. Easily. That all that's going to be wiped out. 10-year Treasury yield spiked up, of course, last week. Should not have. No more bids. Keep in mind, in the next chart I'm going to show you is the US dollar. The dollar itself is falling. All that money flowed in over the past 6 to 9 months, and it was looking for something to do, so banks lent out money. Well, all that money is now leaving, which means businesses who are looking to finance to grow their businesses will no longer be borrowing. It's not going to be zero, but a lot of projects are going to be pushed to the back burner until things are more predictable. Right now, too much unpredictability. This will seize up the economy as well. Then we get to refinance $8.5 trillion in June at interest rates that are unreasonably high relative to where we could have been. Given that, that will be a heavier burden on taxpayers here in the United States, while at the same time the Republican Party wants to expand the budget and give tax cuts to those individuals who likely don't contribute nearly as much as 349 million other Americans. So we're going to see an expansion of the deficit with an economy that is coming off of a 4% unemployment rate. Unemployment will continue higher, which means the tax take that the federal government's going to get is going to be less, which means the deficit is going to increase. And the only way you can entice investors in to take on that excess debt is with higher interest rates. And all that money is leaving the United States, which is going to force the 10-year even higher to entice those investors. It's a big chunk. Here's a look at the US dollar index, and as you can see over the past like 9-ish months, 8 to 10 months, there was a sharp flow of the dollar upward with money coming in, chasing yield. Other countries were lowering interest rates. The Federal Reserve lowered interest rates somewhat, but then paused. And once they paused, that was it. that money flowed into the United States, and this propelled the stock market higher. It propelled the economy further. We look no further than this chart to say all that's gone. And the new basis of foundation for the economy is with a money supply that is deteriorating the rate of growth. The Federal Reserve eventually will have to make a move. And I've been answering a lot of questions via comments in various social media sites. Federal Reserve isn't going to move immediately to save the economy. It certainly doesn't have the ability at this point to save what's happening. Even if the Fed did move rapidly, it's too late and there's more damage on its way. The Federal Reserve more likely is going to remain exactly where they are for a few months. And that's not, everybody's looking for the Fed put. It's just not going to happen. The Fed may actually sit there and say, wow, look at inflation. We got to raise interest rates. It's on the table. And what happens to the 10-year at that point? And what happens to businesses wanting to borrow? What happens to consumers when they're looking at taking on car loans for cars that are overinflated in price and interest rates? We're not even close to the bottom. Here's another thing that's interesting. Saudi Arabia is pretty much like, you know what? You want to find out? You're about to. I can see oil. It's trading, I don't know, about 62, 63. It was trading the 50 handle. And oil itself is an indicator of how the market actually feels overall about the economy. And I'm looking to buy the dip on oil. First, there's a bunch of cheaters. Apparently it's Kazakhstan who has been pumping a bunch of oil into the system despite voluntary restrictions on supply. Saudi Arabia has the ability to undercut everybody by a long shot for a long time. They have a sovereign wealth fund, so if they're losing money in their oil, they don't care. They do, but they don't. And so what the Saudis will do is they'll dump the market with oil to punish those who are not complying with voluntary reductions. So those countries know better, and yet Kazakhstan still stepped forward, and because of that, oil is falling. But oil is also falling because global demand is likely to contract as well, because the United States of America will contract along with world economic output. So oil will tend lower regardless. But then we're also hearing sort of rumors that the Saudis are kind of taking a swipe at Trump himself and effectively attacking, say, the Permian Basin, which I'm in New Mexico, right down there in the southeast corner, northwest corner of Texas. What they'll do is they'll push the price well below 60 in order to bust those new wells, bust the older wells, so that costs move higher. They start laying individuals off. Then the Saudis will lay back on pumping oil. To bring those new wells back online, that takes money. The equipment itself sits there and rusts out, so they have to replace it all. So bringing those pumps back up online costs money. So Saudi Arabia is sort of taking a swipe at the oil industry here in the United States as well. So there's a bunch of things occurring there, and when you put all these pieces together, you see that there's consequences. Now, take a look over the past 3 weeks. The price of oil has dropped significantly. It's been dropping for a while now, but we don't necessarily see the price at the pump dropping. There's not exactly a one-for-one relationship there. Refiners are going to push out what they push out. If they only can push out so much, that's the supply that they have. There's limitations there. So don't necessarily expect that we're going to see $1.50 oil and gasoline anytime soon. Oil companies here in the United States are probably looking at it and saying, you know what? Tap the brakes on refinery. Let's make some money. Let's gouge some more. basically. So there's a lot going on, and we'll get more information regarding the what's going to happen with the economy moving forward. My take is real simple. We're not even close to the end. Wednesday, with the retail sales data points, given the consumer confidence, given consumer expenditures, Wednesday's retail sales number is probably going to be yet another eye-opener. From there, the consequences of all the policy shifts will start to play out. The stock market continues to move over. Myself, and I've been putting out continuous content regarding where I'm shifting. I'm playing currencies again. I try not to anymore because I really enjoy sleeping at night. When I was in my 20s, that was a different story. So I'm shifting back into currencies. I'm looking at the Japanese yen and other currencies, which all that money is flowing out of the United States. You have to sell the US dollar. We've seen a chart on that in order to buy other currencies. These are the shifts that I'm kind of taking place in. TLT, I'm going to have another video coming out tomorrow for those of you who have been following me specifically on TLT ETF. I am not buying this dip. I think the TLT ETF moves much lower. We don't know necessarily what the federal deficit will look like coming forward, simply because the Republican Party hasn't been able to necessarily push anything through. There are some in the House of Representatives that are pausing, saying, man, no way. We'll see how that plays out. My take is they push through for the tax cuts and they expand the budget. Basic bumper sticker, kind of look at what's going on with that. And that will be significantly detrimental to interest rates. They will push higher in order to entice investors into taking on that debt. Simultaneously, Germany and the EU, 1.8 trillion in expenditures increases in order to take care of defense and infrastructure. So you have two competing entities looking for money. Interest rates will have to go higher in order to bring in those investors. Plain and simple. TLT ETF moves much lower. The dollar will move much lower. Oil prices likely to move much lower. The stock market definitely moving downward. We will see some choppy times ahead, and quite possibly eventually there's a tap out entirely on the tariffs and someone claims massive victory. Well, if you're looking at your 401k, it may not be necessarily obvious what the victory was. Plain and simple. For myself, I see this for what it is, and I'm looking to make money in the stock market. If you're interested in this kind of content, make certain to follow along, make certain to jump aboard with the big spike up that I had with Substack. I try to push out, with everything going on, I'm going to have to push out a lot more content, plain and simple, and explain economic moves back and forth. So make sure to follow along. We'll see you in the next video.